Hope you're doing good. So this should be just a quick one to give you a few tricks on how to spot fair value gaps. So on a bullish market, if you want to understand a bullish fair value gap, just mark the high of the first candle. And on a bearish fair value gap, mark the low of the first candle. Okay? Let me repeat again. On a bullish fair value gap, we mark the highs of the first candle. And on a bearish fair value gap, we mark the lows of the first candle. First candle is simply means that inefficiency happened here because you see these candles are supposed to be touching at least wick to wick or at least body to body. But minimum is wick to wick. So meaning that the third candle, this candle here, this is the first one, second, third. Now, this candle here was supposed to be wicking at least touching the wick of this one, but unfortunately it did not. And now the second candle, which is the mid one, displaced above the first one, now leaving this gap or inefficiency here, meaning that price was not balanced well. And this literally means that there were traders involved in here, there were orders involved in here, but they were not offered a fair price. So it has to later come back on and rebalance this inefficiency here. So back to it again. Spotting bullish or on a bullish fair value gaps, we mark the highs of the first candle and the lows of the third candle. Okay? We mark the highs of the first candle and the lows of the last candle. And now the mid candle is supposed to be giving us a displacement onto the first candle, leaving this gap behind. Now, this gap behind is an inefficiency that market has to rebalance on later before it moves on higher. The same way into a bearish one. Into a bearish market, the first candle, we mark its low, and the last, which is the third candle, we mark its high. So for example, you have marked the low of this candle here, and you have marked the high of this candle here. Now, the second candle, which is the one that is creating the displacement onto the first candle, leaves this inefficiency here. This inefficiency in real sense or in ordinary markets or where price has been efficiently delivered, this week is supposed to be at least on that first candle. But since it did not go back to deliver, to rebalance that, at least onto this first candle, it leaves behind this gap. Now, this is what we call the gap. The fair value gap, this one here. And this is a bearish one. Okay. So price later has to come on and rebalance that price end. And as you can see, this over here, it came on rebalance and a little bit started, moving away from it. And maybe people wanted to short it from there, would have just maybe, I don't know, something like that, and then they target this low here, and that was all maybe just the target 1 to 2, and which unfortunately price did not really rebalance, because now based on liquidity was already taken here, and this was now already a bullish market, so meaning that this bearish move wouldn't be respected because it was so interested into going higher here again, tapping this liquidity. Because remember, these fair value gaps are always how to trade them. You have to first of all spot external range liquidity and use the fair value gaps as internal range liquidity. And I'm not going to go deeper into that, not to confuse you. But this video was just to give the beginners an introduction to how to mark their fair value gaps properly. And as I've said for the last time, guys, on a bullish fair value gap, remember fair value gaps must be created with three candles. I did an introduction to fair value gaps on another video, so if you haven't checked it, go check it out. And I've said that you mark the high of the first candle and you mark the low of the third candle. That is on a bullish fair value gap, and ensure that the second candle has displaced above the first candle, giving us that inefficiency. And that inefficiency is now the fair value gap that talk about that later on price has to come and rebalance, given that it's on a bullish market. And you see, for example, this one was not really filled, and there's a reason why it was not filled, and that's why ICT often tells you guys that enter at the consequent encroachment. So if you had entered here, for example, these are long. Now with understanding that this is a bullish market, given that we have taken the sell side liquidity over here, and the price gapped up there. We created that 15 minutes fair value gap. Remember, I'm using a 15 minutes time frame, and our next target will be this one here, this buy side liquidity. And you see, you enter on the consequent encroachment, put your stop loss below here, and that's 1 to 2.5 R. Okay, as simple as such, not complicated. The same thing happened this morning. Let me show you again. We had this bearish fair value gap here, whereby price, gapped down, leaving this in any. Sorry, I don't know. Almost started speaking Swahili. I do speak Swahili, guys, sometimes, and sorry about that. So let's get back to it. So we created this bearish fair value gap here, and price had to come back and rebalance it. And what are we targeting? There was an inefficiency here that had to be rebalanced, and there's another one here. There's another one here. So you could target all this one slope, all this one below there, understanding that liquidity had been taken already, or we have rebalanced our liquidity. And from the look of it, from this other side, we had already rebalanced some liquidity here. But this is quite a low probability trade, because it's not really good to just take any fair value gap or trade any fair value gap without having confluences, like, for example, break of structure. For example, if we displace below this low here, we have a break of structure down, then we have a valid bearish fair value gap, then we wait to enter on sells or shorts from that fair value gap. So that's it on this video. Hope to see you in the next one.